A stock trading at 8 cents is not where most investors expect to find exposure to AI infrastructure. Yet beneath that price is a company operating in the part of the AI ecosystem most people ignore, the data resilience and disaster recovery layer that keeps enterprise systems running when things fail. While headlines focus on chip designers and hyperscalers, institutional capital has quietly been flowing into infrastructure stability, backup systems, hybrid cloud continuity, and secure data replication. And when capital rotates toward the plumbing of AI rather than the spotlight, that's often where overlooked valuation gaps form. Before we reveal the name, consider what this type of company actually does. This is not a speculative AI chatbot story. Its platforms support enterprise-grade cloud backup, disaster recovery, cybersecurity protection, and business continuity infrastructure. It integrates into hybrid cloud deployments and mission-critical enterprise environments. In simple terms, when data centers fail, when ransomware hits, or when infrastructure needs redundancy, this company operates in that defensive layer. That positioning matters more in 2026 than it did 5 years ago. AI workloads dramatically increase data intensity. Training, inference, distributed compute, all of it multiplies storage complexity and system risk. Enterprises running AI applications cannot afford downtime. The more AI expands, the more resilient infrastructure becomes non-optional. Now, around the 2-minute mark, here's the reveal. The company is Data Storage Corporation, trading under the ticker DTSDW on the Nasdaq at approximately $0.088 per share. Revenue has shown periods of stabilization and restructuring, reflecting a smaller cap transition phase. The company has focused on recurring revenue models tied to managed services and long-term enterprise contracts rather than one-time hardware sales. That shift is critical. Infrastructure service models tend to command more predictable cash flow when executed properly. Now here's where nuance matters. The reason the market hasn't rewarded this company is scale. It operates in a competitive space dominated by large cloud providers. Growth has not been explosive. It has been incremental. And in penny stocks, incremental progress rarely attracts speculative momentum. But infrastructure investing is rarely about hype. It is about durability. The company maintains exposure to regulated industries where compliance, redundancy, and uptime are mandatory. That client profile creates stickier contracts compared to consumer-facing platforms. It also reduces volatility in revenue cycles. On the balance sheet side, smaller infrastructure companies typically face capital constraints, and this one is no exception. Expansion requires disciplined cost control. That is one reason the stock remains at microcap levels. Investors question whether it can scale fast enough to matter in a rapidly expanding AI data center cycle. But here is the structural angle. AI growth is not just about GPUs. It is about the entire digital backbone: storage, backup, replication, cybersecurity, and continuity. As enterprise AI deployments expand inside U.S. data centers, secondary infrastructure providers may see indirect demand growth without competing directly against hyperscalers. The company's strategy centers around hybrid cloud architecture and secure disaster recovery solutions that integrate into existing enterprise IT frameworks. Instead of trying to replace large cloud vendors, it works alongside them, positioning as a resilience partner rather than a primary compute provider. That distinction reduces direct competitive pressure. Now let's talk risk clearly. This is a sub-dollar, micro-cap infrastructure company. Liquidity is limited. Volatility is elevated. Capital access matters. Execution discipline matters even more. If revenue stagnates or cost pressures increase, the downside can be meaningful. This is not a low-risk investment. It is a high-variance infrastructure positioning. But here is the valuation asymmetry question. If U.S. data center expansion accelerates into 2026 and beyond, and if enterprise AI deployments increase demand for redundancy and compliance-driven backup systems, companies positioned in the data resilience layer may benefit indirectly. At $0.088, the market is pricing in minimal expectation of scale. That creates the core tension. Is this a structurally constrained microcap that never scales? Or is it a small infrastructure layer positioned adjacent to one of the largest technology build-outs in modern history? That's the lens this analysis should be viewed through. AI growth isn't just about flashy chips, software, or chatbots. Behind every headline deployment lies a complex web of infrastructure that makes large-scale AI possible. The servers, storage networks, cooling systems, and data continuity mechanisms are often invisible to the public, yet they determine performance, reliability, and operational cost across enterprise AI projects. Overlooking these foundational layers can make even sophisticated investors miss the real engines driving AI expansion. While retail attention chases headline AI plays, institutional capital often quietly rotates into these foundational layers. Hedge funds, strategic investors, and long-term portfolios spot mispriced infrastructure assets before the broader market reacts, positioning themselves for asymmetric opportunities. The tension arises when these systems are critical to AI's scalability, yet still trade at fractions of headline valuations, creating a disconnect between strategic importance and market perception. At first glance, these smaller providers may appear unremarkable, almost invisible. But when you map their systems across real-world AI deployments, from cloud-scale data centers to latency-sensitive analytics networks, the value becomes clearer. They are the backbone that enables high-profile AI models to function efficiently and reliably. This quiet positioning often goes unnoticed, leaving a window where valuation lags behind strategic relevance, and the market has yet to fully price in the implications of these infrastructure plays. This discussion is for educational purposes only and should not be taken as financial advice. The objective is to explore how smaller, often under-the-radar infrastructure providers fit into the broader AI expansion narrative, and why their business models, deployment strategies, and market positioning sometimes create valuation gaps that the public hasn't fully recognized. In markets dominated by the headline AI leaders, the chips, cloud platforms, and generative AI models everyone talks about, the quieter layers of the digital backbone are frequently overlooked. These layers include specialized storage networks, real-time data handling systems, and other critical components that enable enterprise AI to operate at scale. Sometimes these providers remain unnoticed for valid reasons, such as smaller market caps, niche deployment focus, or slower public communications. Other times, they represent true asymmetric positioning, highly strategic technology that supports the AI ecosystem but trades at a fraction of the multiples seen in more visible sectors. The key for any investor, researcher, or analyst is understanding the difference between a company being overlooked because of risk versus being underappreciated despite strong strategic relevance. Recognizing this distinction allows one to evaluate potential opportunities with a much clearer perspective, rather than simply following the hype around headline names.